Hi, I'm Max Keiser. This is the Keiser Report. Zombies in the news again. Stacy?
Max, that's right. From Barry Ritholtz, the word of the day, zombie debtor. A zombie debtor is a noun, an indebted consumer who is only able to pay the debt interest each month.
Right. So the debts never go away. They can only pay the interest. They're always in debt. And this applies throughout the entire economy, not just on credit card debts, but mortgage debts, anything that touches the consumer. Now, if you look at the bankers, of course, they're involved in a very interesting situation in that they never pay interest on phantom debts. They loan into existence phantom debts that are uncollateralized, that they themselves only understand the configuration thereof, but they never have to pay interest. However, they get awarded ginormous fees. So here you have the two pillars of society. Zombie debtors who never escape debt, and clown bankers who never have to pay debt. So it's zombies and clowns.
Yeah, wherever there's a zombie debtor, you can be sure there's a zombie creditor and a zombie central banker feeding them all. The Fed is starving economy of interest income. So Warren Mosler, a former broker, manufacturer, and co-founder and distinguished research associate of the Center for Full Employment and Price Stability, says the Fed is part of the problem rather than part of the answer. This is why we have so many zombie debtors. He said it would serve public purpose if the Fed made it clear that in today's rate environment, what's called quantitative easing, in fact, removes interest income from the private sector, thereby functioning much like a tax and a source of what's called fiscal drag, as it takes net dollars out of the economy as it reduces the federal deficit.
Well, yeah, right. If there were not this zombie debtor effect, you would have an accretion of interest income, which would form the basis of the capitalism, something called capital. Without the capital, there is no capitalism. You see? Get it down in the hood. The zizad, or the zizad, or the capitalizizazat.
You should have taken that conversation to Davos, Max. The whole world would be devoid of these zombie bankers instead.
I wanted to make a protest igloo in Davos. That looks like fun. Rub noses with some of the locals.
Warren Mosler then goes on to a second point. He said, this brings up my second criticism with regards to the interest income channel. Lowering rates in general in the first instance merely shifts interest income from savers to borrowers. But he then goes on to say that while income for savers dropped by nearly the full amount of the rate cuts, costs for borrowers haven't fallen that much, with the difference going to net interest margins of lenders. Thus, you're enabling and feeding and empowering the zombie bankers.
And, think of it this way. The capital is flowing through the economy. It's a pipeline of capital, if you will. And the lower interest rates have the effect of shutting down the pipeline of capital and causing deflation. The central bankers are saying, well, we need lower interest rates to increase liquidity in the system. That's patently false. It shows that they have absolutely no idea how this economy works. Someone like a Chris Whalen, for example, who's a true banking analyst, will tell you in order to get the cash flowing again, you need to start to raise rates and incentivize banks to lend to each other, thus creating the basis of an inflationary scenario that would create the jobs and the growth that some people say is their objective. But clearly it is not.
But let's talk about this point here, Max, because you've often talked about raising rates, and all the time you hear screeches of horror that this cannot possibly happen, because when the Fed cuts rates by 5%, as it has done over the past few years, we get 0.05% taken off our interest rates that we have to pay for our mortgages. All the rest goes to the bankers. All the rest is taken from savers and shifted to bankers. So there is a vocal portion of the population who screeches in horror and pain, and their voices get heard out over the people who are savers and who could possibly provide the capital from which capitalism can once again return to the American economy.
Right. In the currency war, it's asymmetric. They lower rates, but the benefits accrue 99.9% to the lenders, the financial establishment on Wall Street, very little of the benefits go toward people who are in the consumer economy, who are the basis of the economy, toward lowering their rates. So there is no benefit on the consumer side. On the banking side, it stifles lending within banks and creates a illiquidity, which is, of course, contributing to the deflation. And then the central banks say, we don't know why there is deflation because we keep shutting off the liquidity and we don't understand why the taps of liquidity are drying up. It shows a pattern of psychosis, which I think most people now understand.
Well, I think most people understand that, in fact, the intent is for no money to go to the zombies, because those are zombies. Why would you ever want those peasant zombies to ever have any money again to pay off their debts? You want them just eking out a tiny sort of subsistence level. But you want those zombies shrieking to empower and to enable a vastly growing sector, the finance sector. Lloyd Blankfein gets more powerful, Jamie Dimon gets more powerful, the banking sector gets more powerful exactly because of this squealing, desperate zombie debtors.
Well, look at all these pension accounts. Like CalPERS, for example, the biggest in California, one of the biggest in the world. They assume 7% return on investments, which assume interest rates at 4 or 5 or 6%. The interest rates for them, because they're less than 1%, they're close to zero. Their return last year was 1%. And they're just being essentially discarded by this form of economic or financial oppression, as it's called. There's a technical term for it, financial repression.
So former chief economist for Morgan Stanley Asia was interviewed at Davos along a similar theme as well. Stephen Roach explains how the Fed is pulling the wool over our eyes. So we have a lot of squealing zombie debtors in America and the UK and other debtor nations, Australia, Canada. Anytime the notion that rates should be raised, they shriek and it never happens. Well, Stephen Roach talks to Bloomberg and he talks about the fact that China is actually doing a lot better because they've introduced over a dozen margin requirement rate hikes, and they've also raised rates so that real interest rates are actually in real terms positive. And then he goes on to say this when he's asked whether or not this would be possible in a democracy.
Can a democracy do those actions? Do they have a terrific...
Have you ever met Paul Volcker?
Well, yeah, but
Okay,
where's the Paul Volcker right now?
That's an excellent question, Tom. I mean, you're as tall as Paul, but we need a central banker who can really deliver the goods. And we've got central bankers right now who are, I think, trying to pull the wool over our eyes with zero interest rates and this magic called quantitative easing.
Yes, well, the Paul Volcker example is a good example. They had the inflation that came after Nixon closed the gold window, and you had gold spiking in price, and you had massive inflation, stagflation, and Volcker came in, raised interest rates, and set the stage for Reaganomics. Reagan just inherited everything that Volcker positioned ahead of that economy. Raising rates increases competition because it forces out the speculators who are merely parasitical in their behavior. The bankers are just being parasites. They want lower rates. Higher rates would force those guys out and bring in entrepreneurs who are doing something other than just financial speculation. It would be the best possible thing you could do for the U.S. and global economies to start raising interest rates, forcing out the speculator parasites, and giving people with savings a return on their investments, the pensions. It would also have the effect of raising real wages.
So let's go on to more of this magical thinking. Economists versus Americans. A new survey finds that just 23% of Americans say they trust the U.S. financial system. That is as low as the earliest months of the economic crisis. And 62% describe themselves as angry or very angry about the nation's economic situation, the highest level since March of 2009. Now, this is a study done by the University of Chicago and Northwestern University. They also have a specific question they asked those they surveyed, and they said, predicting the stock market. Very few investors, if any, can consistently make accurate predictions about whether the price of an individual stock will rise or fall on a given day. Economists, 64% strongly agreed that you can't predict markets. Americans overall, 54% agreed that you can't predict markets. That means 46% of Americans believe that you can magically predict where markets will go. And so, Max, does that explain to you why they might be losing money to brokers and bankers?
Well, there's 2 points there. The first point is one of financial illiteracy. Now, the fact is that rising interest rates would benefit consumers, benefit the economy, benefit wage earners, benefit retirees, benefit competition. Look at the comments underneath this video as it's playing on the internet right now. Read the comments below this video that you're watching right now. Look at all the comments from the financial illiterates who don't understand this basic financial concept, and that is the part of the big problem. The second problem is, in terms of predicting stock market results and prices, only broken markets are predictable. Markets that are functioning are unpredictable. That's what makes markets a supplier of cheap capital. Are all of the losers who can't predict outcomes provide cheap capital for the winners. If it were predictable, you'd have price fixing, and then you'd have more of a state, purely black, heavy hand of the state controlling the entire market. That's not what the market's all about. And this whole moniker of prediction markets is completely false. There is no such thing. Markets cannot predict outcomes.
But let's talk about beyond prediction markets, the actual financial markets that we exist and live in today in our economy. Because this is bizarre that's what 36% of economists believe you can predict outcomes. And it is the maestro, Alan Greenspan, I think, that helped brainwash the economy into believing that you can create outcomes with this magical wand and magical thinking.
Right, that's exactly what Stephen Keen says in Debunking Economics, is that the number one chief ill-conceived notion of economists is that you can predict economic outcomes or market outcomes, and it's hard-coded into the basic textbooks of economics that somehow economics is a science like chemistry where the outcome can be predicted. That's false. Economics is like a social science where the outcome is completely unpredictable, and the second you understand that, the second you understand why Ben Bernanke and his crew are complete charlatans by putting forward some other theory. It's simply not true. Look at the track record of the past 10, 15, 50, 100 years based on this central banking theory. It's been a catastrophe. Stacy Herbert, thanks so much for being on the Keiser Report.
Thank you, Max.
And why are our shirts match?
It's magic.
Don't go away, much more coming your way. Stay right there. Hi, I'm Max Keiser. Welcome back to the Keiser Report. Time now to go to London and speak with Ned Naylor Leyland of Cheviot Asset Management. Ned, welcome back to the Keiser Report.
Thank you, Max. I'm wearing a special silver tie just for you.
Oh, excellent. Now, Ned, silver is well over 20% for the year in 2012, and it's in backwardation. So first tell us, what is backwardation?
Well, backwardation is the opposite of contango. Normally in the precious metals market, you'll find that the futures curve will show you effectively the contracts trading higher than spot rather than lower. And backwardation effectively shows that there's extreme tightness in the silver market at the moment. We're seeing the spot contract trade daily just a smidgen higher than the front month, which is March. And this is very, very bullish, and particularly in precious metals, one wouldn't expect to see that. And it does appear to be have been created by the problems with MF Global. Bear in mind that precious metals investors are the most sensitive investors of all to counterparty risk. And of course, what happened with MF Global was an extreme counterparty event. And that leads many people to leave the futures market, and the pressure has gone onto the spot market, which is very bullish for 2012, and I see this as being a major change.
Okay, so last year, the powers that be, the central planners and the central bankers who don't like precious metals because it makes them look stupid when the prices go up, they were raising margin requirements and trying to get people out of this market. But at the same time, MF Global and JP Morgan stole people's account money right out of their account. So all of that worked for nothing, because now people are dumping their rigged market JP Morgan, MF Global accounts and buying physical. And this is causing the near-term price to get higher than the outward price, so-called backwardation. And this trend is clear indication of the silver bull market is well in place and going much higher, I would imagine, Ned.
Yeah, absolutely. And bear in mind as well, we have the the second element of this, which is the fact that Eric Sprott is back in the market for $300 million worth of physical. Of course, when he announced his first purchase of physical in, I think it was October of 2010, the price was around the sort of $18, $20 level. And when you think about a market that's got extreme physical tightness like silver does, and someone comes in and demands delivery of physical in size, it was no surprise to see that as a major catalyst to the run-up to near $50 that took place over a period of about 6 months. And I think it's very interesting that we've got backwardation and Sprott back buying in size. And bear in mind that this 300 million is only 1/5 of the overall shelf offering. So yeah, I see it as a profoundly bullish confluence of events at the moment, and I have high hopes for this year.
All right, now, Ned, well-known derivatives expert Janet Tavicoli recently suggested, both in writing and in a televised interview, that there was clear manipulation in gold and silver. This manipulation, she said, was most evident during the options expiry months. So this is now becoming mainstream, that gold and silver are openly manipulated, something we've talked about before. Do you think there's a growing awareness now that these prices are fake? Number one. And what about this idea that the manipulation clusters around the option expiry months?
I think it is becoming more accepted. People, when I discuss it, people don't look at me as a sort of crazy person, as they may have done 7 or 8 years ago. I think there's still a degree of apathy, if I'm honest, about the subject. But reference what Janet Tavicoli was saying about option expiry, I think there's some truth in that. But I think that the manipulation of gold and silver is so blindingly obvious, Max. You'd sort of trip over and hit your head on the floor if you weren't able to see what was going on. It's very, very clear. And bear in mind that that lawsuit that we discussed last time I came on is something that people should revisit and reread. If they have any sort of query about what may or may not be going on, read the consolidated class action lawsuit about what JP Morgan have been accused of. And I think it becomes very clear that silver's a much smaller market than gold. And as a result, both are being manipulated, but the footprints of the manipulative behavior is much more obvious in silver. Yes, I think there's some truth about the option expiry, and certainly in the past, that was an area where you would see sell-offs into option expiry so that contracts didn't expire in the money. But of course, of late, that's been blown out of the water. I just think that the evidence overall is overwhelming. And I would say to you that, what we've got is the London Gold Pool that was around in the 1960s. So the difference was then they were selling real physical into the market. It still exists. It's just a surreptitious version of the same thing that existed all along, which is a managed retreat of physical metal against paper currencies. And I think really, it's now accepted by an increasing amount of knowledgeable commentators this is going on. I don't think it's hit the public yet because the public are still learning about the true nature of money and what it used to be and what it will be again.
Okay, talking about the true nature of money, Ben Bernanke in his recent statement is talking about interest rates remaining at effectively zero through 2014 and beyond. So here you have a situation, Ned. You have a piece of paper that pays no interest, that is subject to counterparty risk, that is confiscated openly by banks like MF Global, that the rest of the world hates and is doing bilateral deals outside of this piece of paper, the US dollar. And I'm talking about, of course, what's going on with China, India, Iran, Russia, Brazil. Or you've got gold bullion. What do you go for?
Well, I mean, gold is reverting to its traditional role as the world's reserve currency, Max. It's very obvious in my mind. I mean, think about the last 100 years. There have been 2 global reserve currencies, gold, followed by the dollar, and we're going back onto gold again. That's the way I see it. And I think that probably the most telling thing of all is the Eurozone buying. The Germans are hand over fist in the physical market buying huge tonnage. And I think it's extremely interesting that you've got the world's two creditor nations, China with the US and Germany with the Eurozone, if you want to, put it like that. And they're out there and they're buying serious amounts. And I think that, this is a major change. And I see this leading to, for want of a better phrase, gold fever in 2012. I see this is emerging now. I think the FOMC comments and the way the market has reacted to those comments, most importantly, because there have been other comments in the last 12 months which the market has chosen to ignore. But I think this is all leading to the reversion to the mean, or whatever other way you want to put it, which is gold is money. Gold is the world's reserve currency. It always was. And it's reverting to that status.
All right, Ned, you mentioned Germany and their gold position. They've got roughly 3,000 tons. It's the second biggest gold position in the world, second to the U.S. However, 60% of that bullion is held at the New York Fed, and this has been confirmed at the Bundesbank. So in a currency war, as some call it, it might be difficult to get that gold back. And certainly countries like Venezuela are aggressively repatriating their gold, and countries are talking about getting their gold back into their own countries. Is there a risk that the U.S., as some have argued, declares financial martial law, keeps Germany and other European gold in New York, won't let it go, and as part of this emerging currency war? Your thoughts?
Well, if the kakistocracy remains in power, the way it is at the moment, then who knows? I suppose it's a possibility they could try that. The German buying I refer to really is the retail side. It's the German people who are sort of going over the top of their government and the way the government are behaving and are buying physical in size themselves. Overall, the biggest and most important thing, aside from whether or not the New York Fed's gold is either there, it's hypothecated 400 times over, whether the Germans will get it back or not. I think that these things live in the world of political management as opposed to what's more important, which I've said ever since I first came on and spoke to you, which is that what matters is the people, that the people go out there and effectively get ahead of the curve and start buying physical themselves. And I think that they can dictate the political route here. And I don't think that necessarily will be the case. Of course, the Americans have lots of military hardware to back up a potential confiscation of other nations' gold, but I see that as a fairly extreme potential possibility or outcome.
All right, let's do a little forecasting. Last year, you were talking about a $2,000 gold price, and a lot of banks now are raising their targets for gold, and they're now raising it to that $1,700 to $2,100 per ounce level. What are your thoughts for 2012, 2013? Do you still see 2,000 in the cards, and where do we go from there?
Well, I think it's just a linear progression would take you to 2,000. I don't think that's a particularly big deal. But the point that you make about the banks is in my opinion, extremely important. I think this makes a huge difference. Something which all the way through this bull market when I've been investing, it's been a source of enormous frustration to me when analysts come in and they sit in front of you and they say, yeah, we like this stock, these are our top 5. But meanwhile, we think gold's going down $100 over the next 12 months. Well, of course, no institutional money is going to go into the market when that happens. So I think the fact that the banks are projecting higher gold prices, and not just 5% higher, but substantially higher, can lead to a major sea change in the way the market moves. Because ultimately, the institutional generalists, the ones who are the asset allocators and are moving the money around, they may well like the idea of a particular gold mining stock. And they may see the fact they're now paying dividends and think that's interesting. But if they're also being told by the same analysts that they think the price of spot is going lower, you're very unlikely to see any money come in. And I think that's an enormous reason why the mining stocks have performed so badly for a long time. But I think personally the fact that the banks are making these big projections, for higher prices, whether or not you or I, want to pick a particular line in the sand as to where we're going, but we both say it's going higher. But I think what's more important is what the banks are saying and what that means potentially for 2012.
Okay, last question. In terms of these banks allocating money to gold and silver as part of their asset allocation, at the moment, less than 2% of the global investable assets are in precious metals, which is a very small fraction, versus, let's say, the 1970s during the last major bull market when that number got up to 10% and beyond. Are those numbers correct? And do you see that those numbers expanding to that 70s level of 10% or above, which of course would mean hundreds of billions of dollars now looking at this market?
Well, firstly, no, I don't think they are correct. I think, whether you want to bring in the shadow banking system, the derivative system, whatever you want to relate it to, the type of gold investing that was going on back then is very different to the type of precious metals investing, I'd include silver in that as well, that goes on now. So effectively the leverage was much lower. And I'm pretty sure that that number that you said of 2% would include all different forms of gold and silver instruments. So no, I think it's lower than that, and I think it has the scope to go much higher. Picking a number, I wouldn't do that. And bear in mind that we are in a situation now where paper currencies across the planet are racing each other lower. And so I think what we're seeing is a paradigm shift rather than just an asset allocation, shuffle from 1 to 10. We're seeing a whole paradigm shift about what money is, the way the world's moving. It's such a big change that I think that picking a number in a let's say a linear way like that is I wouldn't wish to do that.
All right, fair enough. Ned Nather Leland, we're out of time. Thanks so much for being on the Keiser Report.
A pleasure as always.
All right, and that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank my guest, Ned Nather Leland of Cheviot Asset Management. If you want to send me an email, please do so at keiserreport@rttv.ru. Until next time, Max Keiser saying bye, y'all.